The resilience of the U.S. stock market in 2026, despite a backdrop of economic and geopolitical tension, is largely driven by a combination of aggressive fiscal stimulus, stealth liquidity measures, and a proactive regulatory framework for emerging tech. While the negativity is real, several specific political and policy-driven tailwinds are acting as a floor for equity valuations.
The One Big Beautiful Bill Act, OBBBA, which was fully implemented moving into the 2026 tax year. Tax refund windfall? The legislation is providing an estimated $160 billion in consumer deductions and credits this year. This has led to a projected 44% year-over-year increase in total tax refunds, effectively putting cash directly into the hands of consumers to offset inflation. Corporate earnings support? The act also includes a reduction of approximately $129 billion in corporate tax bills through 2026 and 2027. This provides a direct boost to the bottom line of S&P 500 companies, keeping earnings per share (EPS) growth higher than global peers.
2. Stealth quantitative easing and Fed pressure. While the Federal Reserve is officially focused on inflation, political and structural maneuvers are maintaining market liquidity. Balance sheet management. The Fed has been quietly supporting liquidity by reinvesting proceeds from maturing bonds into short-term Treasury bills rather than letting the balance sheet shrink, a move some analysts call stealth QE. Fed leadership transition. With Jerome Powell's term ending in May 2026, the administration has exerted significant pressure for a more dovish successor. The market is already pricing in a friendlier Fed chair who may prioritize growth and rate cuts over the higher-for-longer stance of previous years.
3. The National AI Policy Framework, March 2026. To counter AI bubble fears, the administration released the National Policy Framework for Artificial Intelligence in late March. This has provided the regulatory certainty that institutional investors crave. Regulatory sandboxes. The framework establishes safe zones for AI development, limiting state-level restrictions and liability for developers. Infrastructure build-out. By treating AI as a national strategic asset, the government has cleared the path for massive data center construction and energy grid upgrades. This shift has transitioned AI from a speculative bubble narrative to a structural industrial build-out narrative in the eyes of Wall Street.
4. Geopolitics as a safe haven trade. Paradoxically, geopolitical negativity often benefits U.S. markets through the U.S. exceptionalism trade. Defense spending. Persistent tensions in regions like Venezuela and Greenland have led to robust, bipartisan support for increased defense spending. This provides a guaranteed revenue stream for the aerospace and defense sectors. Capital flight. In times of global uncertainty, the U.S. market remains the deepest and most liquid safe haven. Political stability in the U.S., even if contentious, is often viewed as preferable to the structural manufacturing challenges in Europe or the slow reflation progress in China.
5. Midterm election year dynamics. As we approach the 2026 midterm elections, there is historically a strong political incentive to keep the economy warm. Interventionism. Government-sponsored enterprises like Fannie Mae and Freddie Mac have been directed to purchase billions in mortgage-backed securities to suppress borrowing costs and support the housing market, ensuring voters feel wealthier heading into November.
Summary table. Markets versus politics. Economic slowdown countered by OBBBA tax credits, $160 billion to consumers. AI double concerns countered by National AI Policy Framework, regulatory certainty. High interest rates countered by Fed leadership change, anticipated rate cuts. Geopolitical risks countered by increased defense budgets and U.S. safe haven status. Enjoying this? Smash that like button and subscribe for more stocks content. Drop a comment below with what I'm reading every single one. Let's get back to it. Thank you.